Okay, so we finished with the initial planning. Let's talk about our percent of sales approach. Okay, so here, when we're looking at percent of sales approach, um, it's just what it says. We're going to make everything as a percentage of sales, so divide everything by sales. Okay, costs may vary directly with sales. If this is the case, then we have a constant profit margin. Depreciation and assets, or interest expense, I'm sorry, may not vary directly with sales. If this is the case, then we don't have a profit margin that's constant. But think about this, folks. First off, we don't know if we have, if we need more assets. Okay, so if we don't need more assets, then not much will happen with our depreciation. If we need more assets, then that's going to have an effect on our depreciation. When it comes to the interest expense, again, what drives our interest? The debt that we go get. So if we don't need any other assets and all we need to do is, hey, we're not running at full capacity, we can just turn those assets up and make them run faster. Or if we have a manufacturing plant, we go from one shift to two shifts. Or if we're running two shifts, now we go to three shifts. If we're running three shifts and we're running constant and you know, wide open the whole time, then to increase sales, we need to go get those assets. And if we have to go borrow money, that's going to affect our interest expense. Okay, so we don't know these decisions until we do our pro forma statements. Okay, we mentioned that dividends are a management decision, and depending on what we do with our dividends, that's going to affect our retained earnings that we're going to bring over from that net income and go into our owner's equity on our balance sheet. Okay, so we'll see how that comes into play. So here we have this toy emporium. We have their income statement. We can see basically we've taken the costs and divided it by sales, so 60%, 20%, and you can see we basically divided every item by sales. Our pro forma statement, we're going to increase sales 10%, and you can see what that does to cost. We get our net income here, and you can see we have a 50-50 split on dividends and retained earnings. Okay. Now, so we move on to the balance sheet. We assume that all assets vary directly with sales. Again, that's assuming we're running at 100% capacity. Okay. Accounts payable will normally vary directly with sales, obviously, because if we're going to increase the assets, we need more inventory going into those assets. And remember, when we're buying our inventory, we want to put it on accounts payable. We want to extend that out as much as we can, right? So that way we get that inventory, we run it through our assets, turn it into product, we sell that product. Hopefully our customers will pay us cash. If they put it on accounts receivable, we want to use our 210 net 30, try to get that payment within 30 days. And then we can use our customers' money to pay our accounts payable and pay for that inventory. Okay. So that's kind of how we can tie all that together. But accounts payable will usually vary directly with the sales. Okay. Notes payable, long-term debt, and equity generally will not vary directly with sales. Again, that the equity part's going to be determined by our dividend policy. Our long-term debt, that's going to be determined by, do we need the assets? Do we have enough money in retained earnings to pay for those assets? And how do we feel about our debt? And do we want to keep going with that debt? Okay. All right. So if we look at our balance sheet here, and we can see, you can see the increase in the balance sheet. We get down to our pro forma statement, and we can see that for our assets, to support that growth in sales, that 10% growth in sales, our assets are going to grow from 9,500 to 10,400. Okay. We look over here and we see that our accounts payable did vary directly with the sales, and we expected that. Okay. We can see that we left our notes payable and long-term debt and our equity, common stock, we left those alone because we don't know if we need money. first off. Second, we don't know where we're going to go get it. But then we come down here to retained earnings and we see it went up by the $660 from our retained earnings from our net income. So when we total up our new pro forma total liabilities, we can see we got $10,250. Now, what that means is we are short $200 in cash, or in financing, in essence, to support the assets that we need to support this growth. Okay, so now we got to figure out, where do we want to go? And quite honestly, folks, in this case, depending on how you feel about debt and what you want to do with your retained earnings and your dividends, there is no one set plug. The plug will be whatever you decide to do. So here, if we're a seasonal business, let's say it's like Christmas tree farming, which is big up here, we're going into October, we know we got to have workers come in to prep the trees to get them ready. Maybe we need to just go out and get a short-term loan right here at Notes Payable, and we'll put that $200 there, knowing that we prep the trees come, November, December, we're going to sell all those trees, and then I'll pay that note off. If it's not a seasonal business, and then we might look at going long term and take 10, 20 years to pay that $200 off. So depending on the type of business we're in and what we're doing, that's going to affect our decisions.